Okay, so today we're talking about IRA planning, 403Bs, 401Ks, 457 plans, etc. Don't get too hung up on titles. For the most part, IRAs and 401Ks work by the roughly same set of rules. If there's a distinction between them, I'll let you know. But typically, I'm going to refer to a qualified retirement plan or any kind of retirement plan to which this applies as an IRA. Most of you, if you're no longer working or have left jobs in the past, have already rolled 401ks into IRAs, so that nomenclature probably applies to the broadest group of people. So let's say you have a traditional IRA balance of $1 million. You also have an extra mortgage that you may not be thinking about. And your extra mortgage, assuming tax rates are 35%, is $350,000. So you've been contributing to your IRA or your 401k all these years, you've built up $1 million balance, and you feel pretty good about the fact you have $1 million saved up. Well, the IRS would like their share, and this is a comparatively low number for people in California. This is just 35%, and if your income's high enough, you could be at 35% federal alone. And if we wind up getting the 3.8% healthcare surtax on top of that, and state income tax, you could be at a very high tax rate. So you do have some tax built in. That's why we do want to defer taxation on IRAs as long as we can. Of course, Congress knew that we would want to defer that, and so they said, well, we'll let you defer until 70 and a half, and then game is up. You've got to start taking minimum distributions at that point. Unless you're still working and you're not working for your own company, you can actually defer the start of your minimum distributions beyond 70 and a half. So just a couple quotes on income tax. The income tax has made liars out of more Americans than golf. And Mark Twain, what is the difference between a taxidermist and a tax collector? The taxidermist takes only your skin. Okay? Taxes are pretty painful in many cases. And then here's another Mark Twain quote, of course. This is a great principle in tax planning. Do not put off until tomorrow what you can put off until day after tomorrow just as well. Now, he's talking about procrastination, but doesn't that apply equally appropriately for tax deferral? Now, you have done the advanced estate tax class, and so, well, you're all experts now, right? So who can tell me what the exemption will be in 2013? For estate taxes and for gift taxes. Anybody? Well, my personal opinion is, obviously the law right now says it goes back to $1 million exemption both for estate taxes and gift taxes. I think it will go back to $3.5 million per person for estate taxes and $1 million for gift taxes. Right now we have actually a $5 million gift tax and estate tax exemption, which is unprecedented. Nobody expected the $5 million gift tax piece because that lets somebody give now. Just think of Daddy Warbucks out there saying, wow, I don't have to die in order to get my $5 million. I can do it now. Well, he's going to use it. Whereas if he has to die to get it, he might think twice, right? So that's why Congress has always kept the gift tax exemption lower than the estate tax exemption. They don't want you to use your full exemption during your life because they know how powerful it is. So it's unlikely to stick around. It was really sort of a fluke in the negotiations. But because this example involves estate tax assumptions, I wanted to at least get that out there. The estate tax is here to stay. We just don't know what the level will be. What I've done here is I've assumed we have estate taxes at 45% and income taxes at 35%. Well, let's say you have a taxable estate, whatever that level is, or ultimately turns out to be, and you pass an IRA onto your children. That is the worst possible asset you could pass to your children. It's called income in respect of a decedent. It has not been taxed yet for income tax purposes, but the full value, you don't get to take, that mortgage, that $350,000 mortgage you owe to the IRS, you don't get to take that off necessarily before you pay estate taxes. So the full value of the $1 million is included in your estate. So look at this. Are we actually double taxing this asset, taking 80% of your IRA away? And look at my tax rate assumptions, 45% on estate tax. The estate tax was just recently as high as 55%. Only 35% on income taxes. Obviously, it could be much higher than that. Well, Congress actually has given us a break. because it's not quite double taxation. They're very, very generous. They've given you a deduction. So if you pay estate tax at 45%, the next line you get an IRD deduction, income in respect of a decedent, which Peter's put up on the flip chart over here, of $450,000. So it's not quite double taxation because they give you that deduction. But look at this, a bargain rate of 64.25%. Now, who here wants to pass assets to their children and pay 64.25% tax? Nobody. Well, the good news is, if you structure your IRA properly, your children can actually defer that tax over their life expectancy and reduce the pain of that cost, the pain of that income tax cost.
Did you, in your analysis right here, include California income tax in that?
No, not really, because, well, it depends on the tax bracket. Yeah. I just picked a 35% rate.
Okay.
So if somebody's maybe at a 25% rate federal and 10% California, this would apply. Okay. But if someone's a top income earner, this should be more like 45%. So it's a very big tax cost.
Does California have a capital gains, or is it just straight ordinary income?
So for those of you who have real estate or stock portfolios that have gone up substantially, you may get excited about the 15%. You should get excited about the 15% federal rate. Unfortunately, California gives you no such tax break for capital gain income. It's taxed at exactly the same rate as ordinary income. So here are just some historical tax rates, just so you can see how they've bounced around. Obviously, the top rate's been as high as 91%. It's probably going to go to 39.6% in 2030. Now, and this has actually been pushed forward 2 years in 2013 and beyond. Here are our top capital gain rates. What you can see here is capital gain rates on the federal level have always been substantially less than ordinary income rates. Therefore, whenever we do tax planning, if we have an ability to convert to or preserve capital gain treatment, we really want to do that. And there are some ways to do that in different areas of the tax code. So let's talk about required minimum distributions. This is so exciting. We get to do math. We get to do some division here, talk about life expectancy and actuarial assumptions and death and all those types of things. I always figure, as an estate planning attorney, when I'm talking to a client, really nothing should be off the table. I should be able to talk about sex and religion and politics, because within 4 minutes of meeting them, I'm already talking about death and money, right? So, I mean, can't we just...
That's why I enjoy doing these workshops.
Yeah.
I kill them all off.
Yeah, exactly. I kill my clients within 4 minutes of meeting them, every time. And for the husbands out there, I kill you first, okay? The wife's always the survivor. It's just, an actuarial thing. You got to deal with it. So we'll have some examples here where we'll kill off the husband first. So this is important to understand, because it shows you the difference between what's called a spousal rollover IRA and an inherited IRA. So it gets a little bit technical, but Congress, when they created the minimum distribution rules, they said, we're going to assume that everybody who is taking distributions from this IRA is living on this money. They don't have anything else saved up. Therefore, we want it to be a very dependable source of income. We want people to feel that they will never run out of their IRA funds. So we'll set the minimum distributions at such a level that if you just take the minimum distributions, you will not dip into your account. How did they do that? Well, mechanically what they did is they said, every single IRA owner, called the participant, is considered married to a spouse exactly 10 years younger. Okay? So if your spouse is within 10 years of your age, you're not considered married to them for IRA minimum distribution purposes. You're considered to be married to a spouse exactly 10 years younger. What that means is, if we're taking distributions based on an assumed life expectancy, that you'll take smaller distributions because your life is considered to be that much longer, okay? And so that's this unisex life expectancy. Now, what about those of you who have a spouse who is more than 10 years younger? Well, this is a pretty good deal because you're stretching it over 2 lives, assuming one spouse is 10 years younger than the other. When you have a spouse who is more than 10 years, you get to use a totally different table that allows you to take even smaller distributions. Okay, it's called the joint and survivor table. So it's proof that there is a tax advantage to marrying a much younger spouse. So apparently it's congressionally sanctioned. That's and it assumes that you have a longer life expectancy. Now, I don't know if anybody has an opinion about what it does for your actual life expectancy. I guess it depends which way it goes. But so our divisor is calculated based on this, whatever this life expectancy that applies to your facts is. Okay. And it's critical because for the participant and the participant's spouse, that's a number that readjusts every year as you get older. So in addition to this, married to a 10-year younger spouse joint life expectancy number or advantage, you also get the benefit of recalculating every year, because every year you get older, your net life expectancy grows. Okay, and so the number constantly adjusts every year to make sure you never run out of money from that account.
Did I hear you correctly? As you age, your life expectancy grows?
Yes. Now, when you get a year older, you don't get an extra year of life expectancy. You know, you get a year older, you get an extra maybe 3 months of life expectancy, whatever the number is. But it does affect this.
That was a new drug that you got.
Yeah. Yes, that's human growth hormone. That's just injections every night.
If you have 5 different IRA accounts, do you have to calculate it on each IRA?
That's a great question. No. Well, you have to calculate on each IRA, but you don't have to just take it out of each IRA. Okay, IRAs, every one of your IRAs is treated collectively as one trust under the tax code, so that you can take distributions from one IRA and have those minimums count across your IRAs. You cannot, however, carry those minimum distributions from your IRA to your 401ks. So if you've got both, you need to pay attention to the different types of accounts, or 403Bs or 457s. Really, if you're not working anymore, the best thing to do is get everything into an IRA so that you've got an easier time administering.
Is there any other reasons why to transfer out of a 401k into the IRA account? To do a transfer?
Yes, there are dealing with transfers down to the kids. We'll talk about that in a minute. But
yeah. You said there's a table, the table for the husband and wife, and a table for the husband and wife if the wife is more than 10 years younger. Mm-hmm. Are those the only two, or do they have one for people that are single?
Okay, the question is, I mentioned that there's a table for the husband and wife with the 10 years younger, or more than 10 years younger. There's also the unisex table. It doesn't matter if you're married or single. Okay, so let's say we have 2 spouses. They are married right now. They're not considered to be married to each other if they're within 10 years of each other. Each of them is considered to be married to a spouse exactly 10 years younger. So the husband could be maybe 5 years older than the wife. The husband will reach minimum distributions time at 7.5 sooner than the wife. He'll also be on a different schedule than she is, because he's married to someone, or assumed, 10 years younger, and as is she. Okay? When the husband dies, the wife, still, her IRA is on that assumed fact pattern that she's married to someone who's 10 years younger. Okay? So one last thing to consider as we go through this calculation. It's a little bit odd. I don't know why Congress couldn't be consistent here, but they're assuming the account balance is based on December 31st of last year. So you divide your account balance by your life expectancy factor. Okay, the life expectancy factor is based on December 31st, based on your age as of December 31st this year. Okay, so for some things you get to go to last year, for other things you go to this year. So it makes a lot of sense. It's, I don't know, designed to keep lawyers and accountants employed. I'm not sure why they did that.
Matt, I want you to repeat this, because what happens a lot is that, you know, your children are a lost cause, but the grandchildren have hope and are wonderful. And so people name their grandchildren in their estate plans.
Yes.
And you just said they cannot take until they're an adult?
They have minimum distribution requirements, which, let's jump here, and we'll take a look at that. So this is how it works for the kids, okay? And I'll come back around to a lot of the questions here on trust and what do we do for kids under 18, etc. So let's say we had a brand new baby girl, granddaughter, who was born just yesterday. Her life expectancy on this single life expectancy table is 82.4 years. Let's just say 82 years to make it simple. Now notice, she's not deemed to be married to a spouse who's 10 years younger, okay? It's a single life expectancy, meaning her life expectancy is much shorter. If she were deemed married to someone, their joint life expectancy would probably be closer to 90 years. So this is an assumption of just a single life. So the way this works, the number doesn't recalculate every year as she gets older. Okay, she starts out with 82 as her divisor. So she takes 1/82nd of the plan balance on her first birthday. She takes 1/81st on her second birthday. She takes 1/80th on her third birthday until she gets to her 82nd birthday, at which time she has to take out the entire account. Okay? Now when she's under 18, so these numbers that you see in these columns, they don't change every year. If your child or your grandchild is age 14 at the time that they become the beneficiary, they have that 68.9 years. It's locked, it's set, and that number does not change, except that it goes down by 1 every year because they've gotten another year closer to when they have to take out the entire account. So it doesn't matter if the baby granddaughter lives to age 100, she has to take the entire account by age 82.
Okay, but in California, to take it in your own name, you have to at least be 18.
Yes.
Okay, does everybody understand that? You cannot contract or have money in your name under 18 years of age. So it's got to be a custodian. Does it have to be 18? Can you in California make it another age?
You can put it in a uniform trust for minors account. I don't use those because even if you can hold it until someone's 21 or 25, they're probably still disabled by the same financial disability. So there are better ways to do that. Let's see.
The reason why I'm saying this is that 18, they get to decide on this money and how to spend it. And sometimes at 18, we're just not the wisest, and we may be doing them a major disservice giving them that much money at that age.
Yeah, well, almost no matter what age, you need to find a way to defer. As you can see on this slide, spending cuts alone, tax hikes alone are not adequate to deal with our deficits. Now, this is not saying that the president hasn't proposed spending cuts, but it does show that it's impossible to get the tax revenue we need short of spending cuts out of the top 2 tax brackets. They'd have to pay 132% and 142% taxes, which, as we all know, is impossible. So we've either got to cut cut spending dramatically, or the middle class will be the target of taxes, because frankly, there's a lot more tax revenue at the middle class than there is at the upper 2%. It's the old Willie Sutton line. Why do you rob banks? Because that's where the money is. So you ask people, why do you tax the middle class? The fact of the matter is that's where the money is, and so it is very possible that there would be tax increases there. So as we go through some conversations on Roth IRA conversions and whether you should do those, or at least convert part of your account to a Roth IRA, consider whether you're in a situation where your tax burden may go up in the future.
Would that also, if you wanted to take out more than your required minimum distribution this year, based on the thought that more than likely next year taxes may be more?
That's a great idea. I tell a lot of clients that some of them don't want to do Roth IRAs for whatever reason, or Roth conversions. But I tell a lot of clients, look, why don't you at least hedge against future tax increases or the risk of them by taking a little bit more than your minimum distribution. I know that's sort of anathema for a tax attorney to say that, to accelerate tax liability, but when we have the high likelihood of higher tax rates in the future, it does make some sense for some people.
So at least know your income tax bracket and if you've taken out your required minimum distribution, maybe take out up to that amount before you move into the next bracket. Do a little bit of tax planning this year with your IRA.
So here's our uniform life table. You can see here somebody who's age 70 has a 27.4 divisor. Now that's sort of theoretical. Okay, you divide your account value by that 27.4. What does that do? Well, if you look at the next chart, what that does is it means you have to distribute 3.65% of your account the year you turn 70 and a half. Okay? And you can see as you get older, it's a larger percentage. And obviously Congress doesn't expect a whole lot of people to make it to age 100 based on this chart. But what's interesting is if you made just 6% on your IRA account and you took just the minimum distribution starting at age 70, so let's say your account started at $1 million, you earned 6% on your money, and all you did was take the minimum distribution. Your account will still be worth exactly $1 million at age 90, and then it will start to dwindle at that time. Congress was serious about making sure that people don't run out of money from their IRAs. So we really got a pretty good deal on the deferral. Now, let's talk about how the kids get deferral, okay? Because this is your retirement account. Congress really didn't need to give you any extra tax deferral. I mean, you've died. You don't really need retirement funds anymore, okay? They allowed you to take distributions over your life expectancy. When if the husband dies and leaves a surviving spouse, the spouse can simply roll the husband's IRA into her own spousal rollover IRA. She then takes distributions over her lifetime. So those two got a nice long deferral. But the kids, this isn't their retirement money. They can save their own retirement money, right? Well, Congress actually gave us a really pretty nice deal. Not as good a deal as mom and dad got. But let's talk about how do we get there. We want to make sure that the kids can qualify for what's called a stretch IRA, meaning they get to distribute or take distributions over their life expectancy. If you blow this, if you do not designate a beneficiary, use a designated beneficiary, which is another word for qualified under the tax code, your kids will not get a stretch and they will pay all of the income tax on that money within 5 years of your death. Okay? So we can only name individuals or special types of trusts. Okay? The fact that you name your living trust as a beneficiary of an IRA and your living trust says, at my death, give my IRA assets to my son Johnny, does not fix the problem. Okay? Congress wanted that to work. The IRS, in its infinite wisdom, decided that there were too many chances that the money might go somewhere else for somebody who's a lot older, and we might have people abuse the system. Therefore, they effectively said, living trusts, we're not going to buy this thing where people are using living trusts as IRA beneficiaries and give them the stretch out. You've got to be careful with that. If your living trust is named as a contingent beneficiary of your IRA, there's a very good chance you don't qualify, or that your kids don't qualify for stretch out treatment. So just a list of permissible beneficiaries. You can name individuals, your spouse, child, grandchild, parent, brother, sister, niece, nephew, your neighbors, certain types of trusts. They don't have to be related to you. But if you name an estate, if you name charity, if you name most living trusts, you may have a problem. Now, I don't want to scare anybody away from charity. Okay? If you name charity as a beneficiary of the IRA, you just have to make sure your executor or trustee distributes the money to charity on a timely basis, because if they don't, then they could cause you to lose your stretch out capability. Some people, if they're leaving money to charity with an IRA, which is a fantastic idea given how tax inefficient it is, will actually create a separate account for the piece that's supposed to go to charity, and then one account for the piece, if any, that's supposed to go to kids.
So it would seem like every beneficiary ought to stretch. Do they?
No. So
why not?
Well, because they have an appointment with the Maserati dealership about 2 hours after mom keels over. So, I mean, think about it. It's sort of like I tell clients it's a triple insult. If you have a taxable estate, all right, the kid just, or mom and dad just paid estate taxes to pass this asset to the kids. Now the kids are saying, you know what? I'm going to go spend $500,000 on a car. I'm going to withdraw it from this tax account and pay income taxes on it, and I'm going to make a really stupid purchase that my parents would not be happy with. So it's sort of like the triple insult: estate tax, income tax, and a boneheaded purchase that has no lasting value.
How long can a designated beneficiary, or what is the process for them to get the money from your IRA account?
So the process for them to get the money from the IRA account, they are named as the beneficiary, and they simply contact the custodian and they say, I'd like to roll this into an inherited IRA account. So let's say the custodian is Schwab. They can contact Schwab and they can say, Schwab, I'd like to open an account with you and roll it to that account within Schwab. If they say, contact Schwab and say, hey, I've got an account over here at Fidelity. It's an inherited IRA account. I'd like you to roll it to that. They can roll it into that account. So,
but let's say they just want to withdraw. Is there anything preventing them? What do they need to withdraw the money from the IRA?
They need a beneficiary designation and a death certificate, and that's it.
So 3 weeks after someone dies, they'll have total access to that account.
Yep.
Okay.
So we want to try to, for a lot of kids, we want to find ways to restrict access. Yeah.
Is there any way the parents can set that up ahead of time, the stretch IRA?
No, you can't be a parent from the dead.
Well, I'll show you how, or sort of how. I'll show you how in a minute, how to lock the kids. There are several ways to lock the kids in, some of them using charitable planning and so forth, protect kids against their irresponsibility.
Matt, I want you to repeat this, because what happens a lot is that, your children are a lost cause, but the grandchildren have hope and are wonderful. And so, people name their grandchildren in their estate plans.
Yes.
And you just said they cannot take until they're an adult?
They have minimum distribution requirements, which, let's jump here and we'll take a look at that. So this is how it works for the kids, okay? And I'll come back around to a lot of the questions here on trusts and what do we do for kids under 18, etc. So let's say we had a brand new baby girl, granddaughter, who was born just yesterday. Her life expectancy on this single life expectancy table is 82.4 years. Let's just say 82 years to make it simple. Now notice, she's not deemed to be married to a spouse who's 10 years younger, okay? It's a single life expectancy, meaning her life expectancy is much shorter. If she were married, deemed married to someone, their joint life expectancy would probably be closer to 90 years. So this is an assumption of just a single life. So the way this works, the number doesn't recalculate every year as she gets older. Okay, she starts out with 82 as her divisor. So she takes 1/82nd of the plan balance on her first birthday. She takes 1/81st on her second birthday. She takes 1/80th on her third birthday until she gets to her 82nd birthday, at which time she has to take out the entire account. Okay? Now when she's under 18, so these numbers that you see in these columns, they don't change every year. If your child or your grandchild is age 14 at the time that they become the beneficiary, they have that 68.9 years, it's locked, it's set, and that number does not change, except that it goes down by 1 every year because they've gotten another year closer to when they have to take out the entire account. So it doesn't matter if the baby granddaughter lives to age 100, she has to take the entire account by age 82.
Okay, but in California, to take it in your own name, you have to at least be 18.
Yes.
Okay, does everybody understand that? You cannot contract or have money in your name under 18 years of age. So it's got to be a custodian. Does it have to be 18? Can you in California make it another age?
You can put it in a uniform trust for minors account. I don't use those because even if you can hold it until someone's 21 or 25, they're probably still disabled by the same financial disability. So there are better ways to do that. Let's see.
The reason why I'm saying this is that 18, they get to decide on this money and how to spend it. And sometimes at 18, we're just not the wisest, and we may be doing them a major disservice giving them that much money at that age.
Yeah, well, almost no matter what age, you need to find a way to defer it.
You've been an estate planning attorney way too long.
There are lots of clients who are very proud of their children, just not their financial skills. So we are careful to have those discussions. So let's talk about some of the finer points about how do we get designated beneficiaries, how do we qualify, and so on and so forth. Okay. So if you do this right, there's a lot of text up here. This is for the people who want to go back and read this. I'm not going to go through every line. If you want to do this right, you should generally name your children as the beneficiaries to get the stretch out treatment. Okay, that's a good tax planning move. But what's the problem with naming them outright, which is what Peter just talked about? It may be a bad shepherding move from the standpoint of they now have access to the money, they can spend all of it, and they can have that triple insult that I just talked about. So let's look at this chart because it's pretty handy. If you get it right and you name the right type of beneficiary, which we'll talk about in a minute, obviously the kids individually are the right type. There are special trusts, there are charities, there are other ways to get tax deferral. But if you do it right, if you die before your required beginning date, they get to spread it over their life expectancy. And if you die after your required beginning date, which is 70 and a half, they also get the life expectancy rule. If you blow it and you're not yet 70 and a half, your kids will have to withdraw the entire account balance within 5 years of your death and pay all of the tax on that money. Okay? And it's very, very easy to blow it. A lot of people blow it by naming their spouse as the primary beneficiary, and they don't name anybody as the contingent beneficiary. What most IRA custodians will do is say, okay, fine, you named your spouse as the primary beneficiary, your spouse is dead, let's look at the contingent. Oh, nobody's named there. Well, we'll just assume you named your estate. Well, what did that do? One, an estate is not a designated beneficiary. So we may have this 5-year rule where we have to take everything out of the account within 5 years. Two, has everybody here in California, or I mean, you guys have heard about the estate planning stuff. You've heard about the joys of probate, how exciting it is and how inexpensive and simple it is. Well, you now have an IRA that's stuck in probate. You have to pay probate fees, you have to go through the hassle, and some custodians will say, once an IRA is in an estate, we won't let it come out of an estate. So they say you have to keep the estate open year after year after year, and the executor makes distributions to the beneficiaries. Now, if we're stuck with this 5-year rule, we know the estate's only going to be open 5 years because we have to take everything out of the account within 5 years. What's the ghost life expectancy rule? This is if the parent dies after reaching age 70 and a half. The bonus is you get to get some deferral. It's whatever the rest of their life expectancy would have been had they lived. Okay? That's why we call it the ghost life expectancy. So somebody dies at 80, if they were assumed to have 9 more years of life, then you would get 9, or the kids would get 9 years of tax deferral. The bottom line is these are both bad. We don't want these. We don't want to blow the designated beneficiary. It's very, very important to review your beneficiary designations and make sure they're done correctly. So here are some things to consider. It may not be appropriate to name your living trust as a beneficiary. All of you should go home and review your living trust. If it's named as the IRA beneficiary, make sure you have language in there that talks about it being a conduit trust. It has to have specific language about IRAs and 401ks, and it must say it's a conduit trust. If it doesn't, then you are stuck with either this 5-year rule or the ghost life expectancy, depending on when you die. If it does say conduit trust, you can get the maximum income tax deferral that's allowed, but that money, every minimum distribution is going to be distributed directly to your child. It cannot stay in trust. And so they may be able to spend it on foolish things, lose it to ex-spouses, lose it to creditors and predators, etc. So So maximizing income tax deferral. Definitely name your spouse first. Okay, who here trusts their spouse? I'm just kidding. I get that question. Well, do I really have to name my spouse? Because I don't know. She might get remarried and give it to the pool boy, or what do I do with that? Well, there are ways you can lock it up in trust and keep it from your spouse, or keep your spouse from controlling it, but you sacrifice that spousal rollover. You sacrifice a lot of income tax deferral by doing that. So trying to control your spouse from beyond the grave comes with a substantial income tax cost.
What about the annuity contracts, commercial annuity contracts? Are they treated the same way, or do they have IRD?
Yeah, they have IRD. I guess it depends on the structure. There are so many different iterations.
Yeah. So if you have a commercial annuity, take a look at that commercial annuity and see if there's some kind of an extension that they could take the benefits over a number of years. Most don't.
Yeah, sometimes the annuity will actually allow you to eliminate the possibility that the kids could withdraw excess amounts from the IRA over time. So, let's see. And then, of course, we'll talk in a little bit about leaving assets to charities. We've got issues of people who have blended families, financially immature children, protection from lawsuits, children with special needs, etc. So here's sort of a cheat sheet for you on how to do it. Name your spouse as primary beneficiary and your children as contingent beneficiaries. That maximizes your tax benefits, but there's no ability to control the actions of the kids. Okay? Name your spouse as primary beneficiary and charities, or your living trust as contingent beneficiaries. If the living trust is drafted properly and has the conduit provisions, that will give you the maximum income tax deferral. It does not protect the kids against lawsuits, creditors, predators, etc. The third one, we'll talk about this in a minute, is creating a standalone retirement trust. So you name your spouse as primary beneficiary and you create this special trust as the contingent beneficiary of the IRA. It's what we call an accumulation trust, which means as the minimum distribution is made, let's say the granddaughter who's age 82, who has an 82-year life expectancy at birth, as that 182nd, 181st, 180th distributions come out of the IRA, it can be accumulated inside of the trust and not distributed to her. It doesn't have to be distributed at 18. It doesn't have to be distributed at 30 or 70 if mom and dad didn't want that to happen, or if the trustee says, you know what, your generation is not the responsible one. We don't want the money going to you. We're going to save it for the great-grandchildren. Whatever the case may be, it allows you flexibility to keep those assets out of the hands of people you don't want getting them. And I don't mean to focus too much on the bad child or the bad grandchild, but what about their rotten spouse? Okay? Or what about their rotten ex-spouse? Or what about the jerk who hit him on the freeway or who staged a car accident? Whatever types of creditors or predators are out there, if you have money in your own name, they can get it. If it's sitting in an accumulation trust, they can't get it. Okay? So you can lose what you own, but you can't lose what you don't own. And so that's why we frequently will use these types of trusts. So there's no income tax, there's no special income tax benefit of using these standalone retirement trusts, but there is protection. Protection for the kids against themselves and protection for the kids against those that would do harm to them. Okay, so here's why we leave it in trust: creditor protection, divorce protection. We keep it in the family. We can provide incentives to the kids. We say, look, you can get money out of the trust for this good purpose, like a first home, cost of a wedding, higher education, but not for the Maserati dealership, etc. So we want to just design our trust to benefit future generations. If they're immature financially, you give them limited access. If they're mature financially, give them plenty of access, but not actual ownership. I certainly don't want to inherit any assets directly. If I ever inherit anything, I want to inherit assets in trust, because that way I don't have to worry about losing it to some sort of crazy lawsuit. Here's a little slide. Someday, son, all this will belong to your wife. I'm trying to find the non-sexist version. It's out there somewhere. I just can't. I've actually seen it once, and it's funnier than this, but I can't find it. And you know, this could be your future son-in-law or daughter-in-law. So that's why we leave assets in trust, to protect against the odd things that happen out there. This begs the question, of course. Now, I know some of you have heard this before. I recognize a lot of faces, but you know the difference between in-laws and outlaws. The outlaws are wanted. Okay? So it's just this, if nothing else, it's in-law protection, okay? So let's talk about some other ways to get not to get tax deferral. We know we can get tax deferral by naming the kids directly. It's very simple, although it's messed up all the time. So please, please, please review your beneficiary designation forms. But if you don't want to name the kids directly and you don't like the idea of the standalone retirement plan trust, or maybe that's not a fit, another alternative, especially if you're charitably inclined, is a charitable remainder trust. You can take your IRA and gift it to this charitable remainder trust that will provide income to your child over the child's lifetime, okay, not just their life expectancy. So that baby girl who was just born, it doesn't provide income just until she's 82. It provides income. If she lives to 110, it provides that income. Now we want to make sure we're careful with the distribution provisions, that they don't exceed the investment returns, etc. But it's a very nice tool to provide a lifetime of income. Whatever's left at her death goes to charity. Now, she's not the best example because she's so young. This trust wouldn't work for her. But if you have a child or grandchild who's in their, say, 40s, this is a great way to provide a source of income to them for their entire lifetime, to avoid any estate tax, or excuse me, avoid any income tax on the IRA, provide a nice big supplemental fund here to generate income for the child. Because remember, the money that's going to charity someday is still sitting here generating income for the child. It doesn't go to the charity until the child's death. It's a really nice transaction. Charitable gift annuity is very similar, except that in this case, you're gifting your IRA directly to a charity that has a license to issue a gift annuity, or as I heard, I don't know if you'd said this to the broader audience, that you can, if you want to get a gift annuity and name your favorite charity as a beneficiary and they don't have a license, you can work with other charities like the Orange County Community Foundation. They will issue a gift annuity and then make your favorite charity or charities the beneficiaries at death. So in this case, the child knows they've got a guaranteed income stream. Doesn't matter the investment returns because the charity is on the hook. Maybe they have reinsurance, but they're guaranteeing that this income stream will go to the child for life. And then at death, whatever's left out of this initial gift goes to the charity. Great way to do philanthropy and provide a nice, stable source of supplemental income to the kids or the grandkids.
Just make sure if you want to follow through on this plan that the charity knows that in advance of your death that a gift annuity should be issued to the child. And we're talking child, we're talking anywhere from 50 to 80. So, you know, we're not talking baby child.
Yep. An outright gift. This is actually the most tax efficient way to gift an IRA. If you have a large estate, your IRA is incredibly tax inefficient. If you have any philanthropic intent at all, that is the asset to start with. Additionally, at least for this year, and it might be extended to future years, you can give up to $100,000 out of your IRA directly to one or more of your favorite charities. It does count towards your minimum distribution. Okay, so it's a great transaction there. So just consider the charitable piece. So let's talk about Roth IRA planning. We're going to jump through some slides here as well. Okay, the most likely candidates for a Roth conversion are the ones who expect one of the following. They expect their top marginal tax rate to remain level or increase. Okay, that's why I talked about some of those policy issues with taxes at the beginning, because a lot of us are expecting tax increases in the future. So you should at least be considering doing a Roth conversion. It doesn't mean you have to convert all of your IRA assets to a Roth, but you might want to consider doing part of it. If you're in the position where you say, I really don't need to spend my IRA assets, I don't know why the custodian keeps writing me this check, it's driving me crazy on the minimum distributions, you're probably in the camp that should consider a Roth conversion, okay? Because there's no minimum distribution if you convert to a Roth. If you're making the conversion at a younger age, you don't have to be 59 and a half or 70 and a half to make the conversion. You can be 25, 35 and make a conversion to a Roth IRA, okay? And if you want to transfer your wealth tax efficiently, if wealth transfer and estate taxes is of concern to you, then a Roth IRA is a potential fit.
Probably the most underutilized tool is the Roth IRA.
But there's an income cap.
No longer. Is there an income cap this year on Roth IRAs?
There's a permanent withdrawal of the income cap. Now Congress could change its mind, but it's gone. So anybody can convert to a Roth IRA now. There's no longer the $100,000 consider is a Roth IRA and a traditional IRA. If your investment return and your tax rates are exactly the same today, or if your tax rates are exactly the same today as they are 30 years from now, 20 years from now, whenever you expect to be taking distributions from the Roth, it does not make a difference whether you're in a traditional IRA or a Roth. That's why we want to make sure that you have a very high level of certainty, or at least concern, that you're going to have a higher tax rate in the future. Just the cutoffs for the different tax rates. Let's look at how you go through the analysis quickly. Okay. If you're in the 25% bracket and you're thinking about doing a Roth conversion, that'll push you all the way to the 33% bracket because you have to recognize that income this year. You have to do 3 different analyses. You have to say, okay, if I pay tax at 25% today, is that a good deal given what I think my taxes will be in the future? Then if I pay tax at 28%, is that a good deal given where I think we're going in the future? And then a third analysis, if I pay tax at the 33% tax bracket, is that a good deal given where I think we're going in the future? Okay. Now remember, the healthcare surtax is 3.8%. It does not apply to IRA distributions. So for those of you who are worried about the 3.8%, it applies to investment income that exceeds $250,000. Okay, if your IRA is more or less your only source of income, you don't have to worry about the healthcare surtax. But if you have apartments and you have a lot of rental income, you've run out of depreciation, you've run out of interest deductions, you've got a lot of cash coming from those apartments, if you have a lot of income coming from other investments, those can actually push your adjusted gross income, excuse me, your IRA distributions can push your adjusted gross income above that $250,000 level, and those rent payments, those other investment payments that you're receiving that otherwise would have been below $250,000 just got pushed up into what we call the healthcare surtax bubble. So there is an indirect way that IRA distributions can make you subject to that 3.8% surtax for the healthcare bill. Yes? The question is, does the 3.8% surtax apply to a home beginning in 2013? There is a $250,000 per person gain exclusion on personal residences. So to the for a married couple, if your home has not gone up more than $500,000, you're fine. If it's above that and your investment income for that year exceeds $250,000, you would be hit with the 3.8% surtax. So it's a fairly limited group that would be subject to that. So let's talk about how you do Roth conversions and Roth recharacterizations. This is one of the coolest things that I've ever seen in tax planning, because every other time I've done tax planning, I had to try to predict what the future was going to be. I had to assume some rate of growth on investment assets. I had to assume future tax rates. I had to assume that a business was going to have the liquidity to do what it was that it needed to do. In this case, with the Roth IRA, we have the benefit of 20/20 hindsight. So let's say you go out tomorrow and you say, I heard Matt speak, I'm really worried about this income tax issue, I want to convert part of my IRA to funds to a Roth. So you go out and you make a Roth IRA conversion, and then the market drops by 40% 2 days from now, and you say, oh, I just paid taxes on this value. I now have 40% less in my account, and I don't really like that deal. It didn't work out for me. Well, you get a redo. You can recharacterize until October 15th of next year, which means you just, it's like putting the toothpaste back in the tube. You say, look, I never did it, okay? If you do it before April 15th next year, you don't even have to write a tax check, okay? Now, if it's April 15th next year and you still haven't made up your mind whether that was a good deal, you pay your tax, and then by October 15th, if you decide it was a bad deal, you undo it by filing a notice with the IRS. You ask for a tax refund, and they give you your refund, okay? So this is just how the process works. This is for conversions from a traditional IRA to a Roth IRA, and you can convert it up to October 15th of the following year, the due date for your tax return plus extensions, without having to pay. You don't pay any penalties. You would pay tax on April 15th because that's when taxes are due, and if you did that and then decided to recharacterize, you'd file an amended return to ask for a refund of those taxes. Let's talk about how to do this strategically. If you have a large IRA, the problem is if you convert tomorrow and there's a 40% drop in small caps, but then a huge rise in large caps, you say, boy, I wish I could just undo this thing as to the small caps, but keep the large caps going in the Roth, because that was a great deal. You can't do that. You cannot cherry pick your assets. The gains and losses in the entire IRA have to go across the entire account. So the way you pick and choose is very time consuming, unfortunately, but you would actually take your IRA account and you would subdivide it into multiple accounts. You might have one with bonds, one with large caps, small caps, whatever the investing style or asset class is. And so in this case, I've just illustrated a simple example. Let's say we have a traditional IRA with $1 million. We put $500,000 into a large caps and $500,000 into small caps. So we've created our separate IRA accounts. Step 2, we're going to convert our traditional IRAs to Roths. Step 3, we do have to pay the income tax, okay, on that. So that was a $1 million conversion amount. So if we had a 35% rate, we would write a check to the IRS for $350,000 on April 15th of 2012.
10% to the state.
And yes, 10% to the state. So you've got to file the return and pay the tax. Okay. Step 4, we say, wait a minute, what's going on here? We've got our large cap went down from $500,000 to $200,000. We don't like that, so we're going to recharacterize. We're going to undo it. But boy, our small caps went up to $750,000. That's fantastic. We paid tax at $500. It's up to $750 the next year. We're going to stick with that deal. Okay, that's how you do it strategically. So you do have to create multiple accounts. So go through this process at home if you're thinking about that. And also, because we decided, remember, we decided to recharacterize this, we've got to go ahead and file an amended tax return to get a refund of our tax overpayment. So there are accounts that are convertible to Roth IRAs. Your kids have got to be careful with inherited IRAs. If you want, if you have a traditional IRA right now, and you say, you know, I don't think it makes sense for me to do a traditional IRA, but it really would make sense for my kids. Excuse me. If you don't think it makes sense for you to do a Roth IRA, but you really think it would make sense for your kids to do a Roth IRA, if you don't think you're going to be around a lot longer, if you've got a major illness or something like that, and you really want the kids to have the Roth, you've got to do it for them. They can't do it for themselves. Once they inherit an IRA, they're stuck. If they do a Roth conversion, they're deemed to have taken the entire account out of the plan. It stinks. It's just the way the law is written. The other way to do it is if you can get your IRA into a 401k. The law is written that your kids can take money out of a 401k, and they have a choice. They can roll into a traditional IRA and pay no current tax, or they can roll from a 401k into a Roth IRA, and they would pay the income tax at that point. So
what do most kids do?
Most kids just go out and do something stupid and spend it. So
why is that though? I'm just, you know, you've been around this business quite a while.
you know, money brings out a lot of different issues, brings issues to light. If the senior generation is gone, sometimes they're the glue that stuck the family together.
Yeah, but do you discuss, for example, the amount that you have in IRD assets with your children?
Very few.
Probably not.
Yeah, very few people will discuss any of this with their kids. I admonish clients all the time. Please discuss this with your kids. Please bring them in. We do family meetings occasionally to make sure the kids are up to speed, because mom and dad make a lot of assumptions about the kids' expectations. Sometimes they say, oh, the kids really, really want this money, and the kids don't. They say, no, I'm doing fine, give it to charity. Other times they say the kids don't want this money, or they don't need it, or they'd spend it irresponsibly. And can you imagine a worse time to find out that your parents made plans for you that don't make a lot of sense for your lifestyle than right after they die?
Well, the other thing too is we don't know when we're going to die.
Yeah.
And we also are forced to take withdrawals. And then we got another addition as to we have no idea what kind of investment return we're going to have.
Yep.
So, you know, your IRAs, your 401ks, 403bs, I see most individuals who inherit those IRAs feel like they just won the lottery. It wasn't planned. We don't know how much. There was never a discussion. Bingo, lottery. I got this X amount. Inherited IRAs and stretch. Most individuals don't do them. And so the money is spent. And then the problem is on April 15th, where do they get the tax dollars to pay the taxes?
Yeah, it's very unfortunate. They get a nice surprise that they've got tax liability due. And you've seen probably 20/20 stories or 60 Minutes on people who won the lottery and how most of their lives are significantly worse, not better from that. And they're out of money in a very short period of time. There's actually an entire institute out there called the Sudden Money Institute. There are university programs that study sudden wealth, and basically they've concluded there's very little good that comes from inheriting sudden wealth. The exceptions are almost always the cases where mom and dad sat down and set expectations, communicated with the kids, prepared them for the wealth, etc. And
Matt, I know I'm the exception.
Exactly. Everybody's an exception. Well, that's what it is. You know, 99% of lawyers give the rest of us a bad name. That's the rule of exceptions. You had a question? The question is, does it seem to be wise to let your adult children know what your net worth is? Well, I'll give you the lawyer answer. It depends. It does depend on their age and their financial maturity. So it's always up to the parents to decide when their children are ready to hear that. I don't think they should know a lot about it until they've already taken steps to be contributing members of society. You know, if they're 16 and you say, hey, you know, chances are you'll inherit $20 million when I die, that's going to suck the initiative. Yeah, it could, and it'll suck the initiative right out of them. Not everybody, not all children, but it could for a significant number. Yeah, if they're over 50, I do have some clients with children over 50 where they're very concerned about financial immaturity. It's just the way it is. But generally speaking, when they're over 50, I mean, that would be a decision for you to make. I've seen that they're significantly more financially mature. Now, sometimes when they get to that point, maybe they should be saving for retirement, and the hope of an inheritance will prevent them from doing so. Maybe they hang on longer than they should. They spend improperly. Instead of saving, they go out and buy a new boat or whatever sort of frivolous expenditure. Everybody's different, but it is important to bring it up when it's appropriate. Okay. The one thing that I'll point out in this piece is, for those of you who are married, there's a very good chance that you will be widowed someday. Okay, one of you will be the surviving spouse. Right now, we have a tax bracket that's different for married taxpayers than for single taxpayers. Okay, so your tax rate may go up simply by the fact that your spouse died. So when you're doing that analysis of where are my taxes going into the future, consider the fact that one of you will be survived by the other, and will be paying, and the survivor will be paying presumably higher tax rates. Okay, that's oftentimes ignored. I still get a lot of questions these days from people who have had issues with they sign personal guarantees on development loans, or they have some rental properties that are underwater and they've defaulted on them, and they're wondering, is the lender going to come after me? If they do, what assets can they take? IRAs and 401ks have a very high level of asset protection. There are different issues though. There's bankruptcy protection and then there's state law protection. They're very different. Bankruptcy protection is only available if you file for bankruptcy. There are downsides to filing for bankruptcy. There's potentially the social stigma, certainly the impact on your credit report, the fact that you don't get to take advantage of bankruptcy protection for another 10 years after filing. But there is 100% protection for your 401ks and 100% protection for your IRAs that were rollovers from 401ks or 403bs or 457s, one of those qualified plans. So those are what are called non-contributory IRAs because they came from employment, the employment context. There's also a $1 million exemption if you were just writing a check to an IRA not related to your employment and we're deducting those funds. There's a $1 million exemption there. Not a whole lot of people have large contributory IRAs because the limits are so small of what you can put in there. Most of them are coming out of qualified plans. But we do want to keep the two separate because of the different creditor protections.
So qualified plans are 403Bs, 401Ks,
yep.
457s. And why do they have those numbers?
Well, just different institutions. 457s a lot of times are for nonprofits. 403Bs
IRS
are for
code. Don't they refer back to the IRS?
Yeah, it's all the IRS code sections that apply. So that's the protection under bankruptcy. So your 401k assets are never going away under bankruptcy. Okay. Now, non-bankruptcy, this is state law where you say, I don't want to deal with bankruptcy, I don't want to deal with the stigma, the hassle, etc. What is the protection? Your 401ks are still completely protected. 403Bs, 457s, the qualified plans here. Okay. But once you roll a 401k into an IRA, state law governs unless you're filing for bankruptcy, which is a federal relief or a federal cause of action. So the biggest issue, or the people who oftentimes look at this, I have a client who's does high-risk pregnancies and births. And there's a statute of limitations that is, I believe it's 21 years from the day that the day he gives the last child, the day he helps give birth to the last child, or helps deliver the last child, because if he damages or injures that child at birth, the child has until age 18 to file a lawsuit, or 3 years after age 18 to file a lawsuit. So that doctor is sitting there saying, I want to make sure my assets are protected. I don't know if I want to roll out of a 401k into an IRA, because I know my 401k is totally protected. I know my IRA, if I don't want to go the bankruptcy route under state law, is only protected to the extent I need it. Now, who wants to have some judge telling you how much money you need and how much money you don't need? So people who are particularly concerned about those types of risks may actually leave their money in a 401k longer term. A lot of times people will also will actually accelerate distributions from their IRA, and they'll buy life insurance because the life insurance can pass free of estate tax. This is for people typically who have taxable estates, okay? Because the problem with an IRA is if you leave the money in the IRA, it continues growing and growing and growing. Well, we hope it continues growing and growing and growing. Well, that's also growing the size of your estate. Well, that means it's subject to estate taxes. But if we could instead take that money out early, get it into a special type of a trust where it's outside of your estate and that future growth is outside of your estate, there could be some very significant estate tax and income tax savings. So it's not always a no-brainer to defer as long as possible. Inherited IRAs, there is no asset protection at all for inherited IRAs. That's one of the reasons that we leave them in special trusts. Charitable gift annuities, charitable remainder trusts, the best asset protection is in a standalone retirement trust that has that accumulation feature that we talked about. There are several recent cases, one just from a few weeks ago, where an inherited or a beneficiary lost an inherited IRA to a lawsuit. So they are not immune from creditors. So in your hands as mom and dad, they're almost totally immune if they're structured properly. In the kids' hands, all of that immunity goes away unless you set up a special structure to protect it.
When would you start beginning to look, or somebody should start inquiring about an IRA trust? How much, because we're going to have fees related to this, so at a certain level it doesn't make sense to do all this planning,
yeah.
But at another level it makes perfect sense.
That's a good question. People generally start looking at IRA trusts. The bare minimum is usually about $500,000 in an IRA. Oftentimes more likely or a better fit is if it's $1 million plus. There are some factors that cause people to look more versus less. If they have special needs children, then they are almost certainly going to set up a standalone IRA trust. If they have a lot of charitable intent, they'll probably set up something like a gift annuity or a charitable remainder trust. If they know that the kids are extremely financially irresponsible, then they're more inclined to look at those types of trusts. And then pretty much anybody with an IRA exceeding $2 million is doing a standalone IRA trust, unless they're doing a lot of charitable planning. But if it's going to the kids, they're almost universally doing these trusts because they don't want that $2 million being lost to whatever ills are out there. The question is, designating a charity as a beneficiary of an IRA. They are not a designated beneficiary. They don't qualify for that. But in that one case, there's an exception that allows you to avoid the problem. And the exception is, as long as the charitable gift is distributed by September 15th of the year following the year of death, then it does not disqualify everything else. So unfortunately, it's a hybrid type of deal. It does taint everything, but there's an easy way to prevent it from tainting the designated beneficiary status.
What 99% of individuals do is they leave their IRD assets to the children, and then if they've named a charitable organization, they do it in their living trust or their will. And it should be the exact opposite, because the charity doesn't pay any income taxes on the assets it receives from the IRD assets, and your kids are not going to be subject to income taxes for the assets they receive under your will and trust. I would venture to guess that in the next 2 years, or maybe even the next 5 years, income taxes are going to be more of an issue for most of us than maybe the estate and gift tax issues.
Oh, sure.
So,
yeah, the estate tax is targeting the top 2 or 3% of the country.
Yes. And whereas income taxes are going to be just a major hit. And most of our families and the beneficiaries have no clue. I can't even remember who I named as my designated beneficiary on my IRA that I put together prior to my marriage.
It was me.
It was you. So get a copy and at least see who's the designated IRA. And remember, on commercial annuities, there is no stretch. Okay? I'm not talking about a commercial annuity inside of an IRA. I'm talking about a commercial annuity outside of an IRA.
So the IRA trust, the standalone retirement trust, does allow a stretch. It has special provisions that a living trust doesn't. Well, actually it has special limitations that are not present, should not be present in a living trust, that allows it to qualify for the stretch out treatment exactly the same way an individual would.
Or primary and secondary.
Yeah, well, no, primary, the spouse should always, in almost every case, I think in every case, the spouse should be named as primary beneficiary. The surviving spouse can roll it into her own IRA. It's a spousal rollover. She gets actual lifetime tax deferral, not just life expectancy. The contingent should be If the standalone IRA trust is proper, the contingent beneficiary should be that trust.
See, what happens when we put our will, durable power of attorney, the advanced health care directive together, usually the attorney says, here's a letter, go to your financial institutions and get your assets named in the living trust. And by letter. In other words, normally in your office, correct, you don't actually transfer the assets from the brokerage account or the financial institutions into the name of the trust. You pretty much assist the client to do so?
Well, it depends on it, but if we just assist, we always review afterward.
Yes.
And we prepare a schedule that's attached to the trust that says, okay, this account is now officially in the trust. We've seen the documentation. It's been done. When I do standalone IRA trusts, because the beneficiary designations are so woefully inadequate as prepared by most of these custodians, I write my own. And then I do that whole.
You want to repeat that again?
Yeah, when I do standalone IRA trusts and we're doing the stretch out planning, I draft my own designated beneficiary form. I don't use what the custodians use because they're really poorly done. There's all kinds of contradictory language. There are bad default rules in there. They don't account for remote contingencies. What if your spouse and your children are gone? A lot of them don't let you plan beyond that contingency. And so I custom draft them, and as you might guess, they're all huge fans of mine. I fight with them all the time. Well, you can't do this. You can't change our form. Why? Show me the law where I can't change your form.
So and most of the financial institutions don't understand this kind of complexity. So if you have a large IRA, if you have a large 401k, take this session today as just maybe, the tip. Hey, we ought to explore a little further and some more, because it is complicated.
Yeah, the question is, if you name your spouse as beneficiary of an IRA, she rolls it to her own inherited IRA, can she name a beneficiary? Absolutely. She can name the pool boy, and you can't stop her, okay? So it's just, that's the way it goes. And that's why some, usually husbands, because it's just the way they're wired, I guess, they want to leave it in trust for the surviving spouse because they say, well, wait a minute, what if she remarries some jerk and blah, blah, blah. You can do that, but you're going to sacrifice some income tax deferral, and I really don't think generally it's the right thing to do.
The national statistic is that all IRD assets are spent within 18 months of your death, no matter what the size of those assets are. That's a national average. We know that every one of us are an exception to that rule. So next week, well, first of all, Matt, great job. Thank you.